Good morning, friends. This is Monday, October 10th. I'm Marv Eisen, the Timeless Dollar, and we begin today looking at the economic calendar as I do every day, and I suggest as you should do every day, to see if there are going to be any market-moving announcements like we saw on Friday. But today, October 10th, there are two announcements. They're not going to be moving the market. Let's move over to the morning news. Flags are in the red, but basically the markets are flat. After Friday's rout, we'll get to that in a minute. Oil is up, of course. That's going to go up from this level. We might see it touch and even exceed $100 a barrel. The 10-year note is trading at about where it was last week, 3.9. Let's move over to the S&P. Now, this is the S&P. This is the big picture, not the E-mini, not the futures. This is the S&P. Each candle represents 1 day of trading. And here we are on Friday, and I want to call to your attention the fact that the market opened after the labor report, which was announced pre-market, and the market opened gap down. As you can see, it opened here at 37.07. This is the S&P, not the E-mini. And the previous close was 37.44. So about a 37-point gap down. Now, gaps always get filled. So let's see if this gets filled today. It may not. Let's go over to the daily charts now. This is the S&P E-mini. This is Friday's chart, and as you know, I put my trading zone on the chart every day prior to the market opening, and I put the previous day's close. This was Thursday's close. And just prior to the labor report announcement at 8:30, the market was coming into trade just at equilibrium, which is to say it was coming in at Thursday's close, right here at 37.56. But of course, when the labor report came out, the market took a dive and rendering my trading zone useless, but not really. So let's see what happens when the market is upset by an announcement. Here's the announcement. And here's where the market opened right over here and continued going down. By 10:30, I saw that the market was not going to be going up anywhere near the previous, where it opened rather. So I took this area here to be the intraday high. So I moved my trading zone down. This is my transposed trading zone. When the trading zone needs to be moved, I call it transposed to the intraday high or low. And I use the range to give me an estimate of where the market is likely to end up. And as you can see, the market did in fact end up at the transposed support level down here at 36.53. It did break that, but then came back up and closed right about at the trading zone support level. Nevertheless, when George Taylor devised the math that underlies the trading zone calculations, this was in the 1950s, and this was before these FOMC and economic reports. There were some reports that came out, but certainly they weren't disseminated to the public. There was no internet then, and there was no way that the market could trade. And then again, of course, there was no electronic trading. So we didn't have these market-moving announcements that had this effect to move the market, and the trading zone really was stable. But nevertheless, we can use the trading zone today to move the trading zone to where the market is actually trading and use it as a gauge to see where the likely other end of the candle is. Remember, each candle, I'm going to go back to a daily chart. Remember, a candle opens at one end and closes at another, whether it's red or green. It opens, except for a doji, of course. The market opens at one place and it ends at another place. So if we knew where the market was open and we knew where the range was, which is what Taylor's method tells us, we know where the market is going to close. So I use this technique. Does it work all the time? My friends, nothing works all the time in the market. But you can use the trading zone to trade the big picture. The trading zone is not a setup strategy. It's a longer term strategy. I teach only 6 trade setups in my course: gap, support and resistance, time and price, trend, momentum, and candlesticks, GST, TMC. And each of these 6, except perhaps the momentum trade, has a setup that you can recognize while it's forming. You can't recognize the momentum because it happens so fast and it just goes. You never know when it's going to happen. But it helps during the time and price trades because, well, I'm digressing. But nevertheless, this is what happened Friday. Now today, I sent my trading zone report out to my subscribers already, and they have the trading zone for today. I will tell you the market is coming into trade just at the close of Friday rather, at 36.53. The market looks like it's trading there. And right now the S&P Emini is 36.56. So the market is flat. We might see a tendency for the market to actually close Friday's gap. We'll see. At any rate, trade safely. Thanks so much for watching. Trade with lots of patience. And remember, if you're trading, you don't have to trade every day. If the whole objective of trying to make money in trading is to eliminate risk. And if you can eliminate risk, you can spot maybe 2 trades a week that have virtually, I'll say, 2% of risk. If you see a hammer with a huge shadow at the end of a downtrend, that would be a very high probability trade that you can jump on to the long side, and that's the kind of risk elimination technique that I'm talking about. Most traders don't have it, but believe me, it pays to trade with patience. So thanks so much for watching. Trade safely, have a great day, and I'll see you in my next video. Marv Eisen for Timeless Style.